Red hot. That's how experts are describing our current housing market. The February U.S. National Home Price Index rose 12% from last year, a gain that hasn't been since 2006. The number of Google searches asking when is the housing market going to crash increased by 2,450% between March and April. So are real estate investment trusts safe from all of this? Find out today how the current housing market crisis could affect REITs this year and the top 3 dangers to watch out for when it comes to REITs. All this in today's video. Welcome back to our apartment locating channel. This is Pierre Meji. I love teaching realtors about the apartment locator business model that they can leverage as a real estate agent. Because how else can you learn how to make a 6-figure income as an agent working from home, simply referring everyday people to their next apartment complex to rent? It's super exciting, but I also put out general real estate content every week for those of you that just love learning about everything there is to know about real estate. Now that that's out of the way, let's jump right into why you clicked on this episode. Experts are saying that this housing boom will continue throughout 2021. New houses for sale aren't coming out fast enough, and building new houses is proving difficult. I mean, have you guys seen lumber prices lately? They've been increasing. For every 1,000 board feet, it costs about $1,372 now, which is a rise by about 130%. So that's reality, right? Computations show an estimated $24,000 difference in the cost of a newly constructed single-family home. So basically, what I'm saying here is that something would need to trigger it for the housing market to drop prices. Right now, the best we could hope for is a gradual cool down. One analyst said first the bids drop and then at a lag, the sellers adapt and lower their prices. And then another analyst commented, with the short supply, we don't expect there to be any sort of significant crash in home prices because there's a lot of demand out there that can absorb any additional supply that comes on the market. Interest rates will most likely rise slowly but are expected to stay near historic lows. So this is where the REITs come in. REITs, or real estate investment trusts, lease space and collect rents on the properties, then distribute that income as dividends to shareholders. Just think about mutual funds for real estate that gives out most of its income as dividends. That's a REIT. And one of the dangers of REITs is its sensitivity to interest rate fluctuations. So without going into the nitty-gritty of it all, rising interest rates are bad for REIT stock prices. That means we're good for now with interest rates near historic lows, right? Well, not so fast. You also have to look into the reason behind these historic lows, which is the economic downturn we're in right now. Most individual REITs are not very diversified. They tend to focus on a specific property type, and each type of commercial property has its own set of risks and drawbacks. If your REIT is like a hotel REIT that's sensitive to recessions and other economic weaknesses, then it's time to rethink that portfolio. If you choose to invest in REITs, it's smart to choose a few with different levels of economic sensitivity. You can also invest in a REIT, ETF, or mutual fund that spreads your exposure among different property types. Another interesting aspect of REITs is their big selling point, right? REITs are required by law to pay out at least 90% of their net income in the form of dividends. That's a high percentage, 90%, right? The average REIT dividend stands at 4.59%. That's more than double the money you could get from the dividends from the S&P 500, averaging at 1.85%. At the same time, this 90% rule also means limited growth for the REIT. With 90% going out as investor income, little capital is left over for acquiring or renovating new properties. Some REITs even borrow money just to maintain their dividend payment, meaning trouble for the REIT in the long run. So to avoid that, REITs cut dividends when income falls and increases them in the time of rising profits. So expect some fluctuations in your REIT income basically. And for the final danger to be wary of when it comes to REITs, we talk about taxes. REITs don't pay corporate taxes, and that's a good thing. To be classified as a REIT, the company has to invest at least 3/4 of the assets in real estate and pay at least 90% of taxable income to its shareholders. If it meets these requirements, a REIT gets a big tax advantage. That means zero corporate taxes. To compare, most dividend stocks are effectively taxed twice, once on the corporate level and again on the individual level when they're paid as dividends. 1 point for REITs there. So it's a good thing for REITs because it wouldn't happen if you invested in the REIT. But here's the con, right? So REITs are taxed as ordinary income. In most cases, the federal government taxes dividends at a lower rate than ordinary income. Unfortunately for REIT unit holders, that dividend tax benefit does not apply to their REIT holdings. So right now, dividend taxes amount to 0% in many cases. Most pay 15% and the highest income investors pay 20%. But for REIT dividends, taxes could go as high as 37%. Average income earners would probably pay 22%. Talk about unfair, right? So if some of that went over your head, here's basically the bottom line, right? The benefits of adding REITs in a well-diversified investment portfolio still outweigh the risks for most investors. But still, it's a good idea to know about these dangers before jumping into a whole new investment, right? So I hope you appreciated this video. So what are your thoughts about what we just went over in this episode? Did I miss anything important about REITs? Fact check me in the comment section below and let me know how I can improve my content on the next one for you. And hey, if you enjoyed the episode, click that like button, subscribe, and hit the notification bell so you can check out my future content. I'm constantly improving my content based on your suggestions, so don't be a stranger and join our family by becoming a subscriber. I mean, making this content ain't cheap. It's me and a team of 3 other people producing this right now, right? It's for you guys to learn and enjoy. So let me know in the comments below if we did a good job on this one. And draw me a little positive comment below, because I'm not gonna lie, it actually makes my day when I read happy comments. And hey, don't miss the next episode coming up because it's gonna absolutely blow your mind.